When trade tariffs swing transportation volumes down 60% to positive 28% in weeks, generic risk models can have blind spots. We take a look at industry-specific risk models in the Commercial Pulse Report for June 3rd, 2025. The Experian Commercial Pulse Report is a bi-weekly report offering a snapshot of the US economy and its impact on small businesses. Let's begin with a look at some macroeconomic highlights. In April, the inflation rate landed at 2.3% according to the US Bureau of Labor Statistics, the lowest increase since February of 2021, offering some relief to business owners navigating cost pressures. The unemployment rate held steady at 4.2%, while average hourly wages continued climbing to $31.06. A resilient labor market is playing a key role in offsetting volatility caused by global trade tensions. Business optimism dipped to 95.8, reflecting a cautious outlook among small businesses. And consumer sentiment fell again in early May to 50.8, the lowest point since June 2022, a sign that broader economic concerns are weighing on households. The April reading of the Experian Small Business Index fell by 4 points to 43.2, down from 47.2 last month and 11.9 points lower than the same period last year. The shift reflects the first measurable impact of the broad tariffs announced on April 2nd. This decline breaks a 3-month streak of improvement. While the index experienced a decline, the decrease was modest due to the continued resilience of the US economy. Some metrics showed signs of deterioration contributing to the drop in the index. The ongoing shifts in tariff policy have created uncertainty among consumers and small business owners. Despite these economic challenges, new businesses continued to form at high rates, with 449,508 new businesses filed in April, nearly matching March's figures and still well above pre-pandemic levels. With the persistent talk of trade tariffs in the business community, this week our research focuses on the transportation industry. The transportation industry, excluding warehousing, contributed $857 billion to the total US GDP in Q4 of 2024. And as a comparison to other industries, you can see here that transportation contributes about 3.3% of US GDP. We're seeing real-time impacts. Shipping volumes from China to the US plunged by over 60% after tariffs were announced. Yet within 2 weeks of a temporary tariff suspension, volumes rebounded by 14.5% and then 28.4%. That's how quickly trade policy shifts ripple across supply chains and credit risk. Our research reveals rising financial stress in the sector, from increasing credit balances and delinquencies to declining credit scores. Experian thought up a way to better predict the payment behavior of businesses in all sectors that utilize transportation financing, like DHL, for example. The objective was to see if a tailored transportation finance model could predict accounts going bad 91 plus days past due on transportation financing trades within a 12-month performance window, better than an all-industry solution. And you can see here how well the model is able to do that. It shows how important it is to use tools built specifically for transportation-related risk, a sector that's facing greater uncertainty. If you're a risk professional, these insights can help refine your approach to underwriting and portfolio strategy. And there's a lot more to our MIDI study of the transportation industry in this week's Commercial Pulse Report. Don't forget to visit our Commercial Insights Hub for more perspectives on small business trends. Also subscribe to our YouTube channel for more updates just like this, and definitely connect with your Experian account team to start a conversation about how industry-specific models can elevate your credit strategy. And last, remember to stay informed, stay ahead, and we'll catch you on the next one.